What's up guys, Jake here. In this video, let's cover potentially one of the greatest ways that some Americans avoid paying taxes. And before we go any further, I am not a financial planner, I am not a tax advisor. Everything I'm going to tell you in this video is subject to change. If Congress decides they want to change the tax law, then this video could become outdated. Now what we're going to talk about is the step-up in basis or the stepped-up basis for assessing tax on investments. Maybe you've never heard of this because it only applies when you die, but potentially if you had a wealthy spouse or parent and you're doing estate planning, then this becomes very significant to you. So in this video, let's break it down exactly what it is, and we'll do an example. So first, to explain it, this includes, this takes effect on investments. So it can be bonds, mutual funds, stocks, or real estate. This doesn't count for your primary residence. Don't worry about that. This is for real estate as an investment. So let's assume that you purchased an investment with a cost basis originally of $100,000. Over a certain time period, maybe 10, 15 years, that investment grew in value to $500,000. Now, if you were to sell this investment one day before you die, you're going to realize a long-term capital gain of $400,000. This is a taxable event, and you're going to have to report it on your taxes. Now, for long-term capital gains, let's go ahead and calculate a $400,000 capital gain. Let's go ahead and assume you have no other income during that year. The 0% tax bracket kicks in for the first $40,000, and then you're paying $15,000 on the next $360,000. So if you realize a long-term capital gain of $400,000, you're going to have to pay $53,000 in capital gains taxes. But definitely nobody likes paying taxes to the federal government if they don't have to. So we have this law to incentivize people to hold investments, and it's called the stepped-up basis. Basically, if you die while holding an investment, you get to pass that investment on to a beneficiary, perhaps a child, Mr. Moneybags Jr. The beneficiary gets the asset stepped up in cost basis to the fair market value of the investment on the day of your death. So we no longer care about the fact that you purchased this investment for $100,000. It's worth $500,000 on the day of your death. It passes to your beneficiary. That is their cost basis now for tax purposes. And for tax purposes, this inheritance stays long-term. So let's say your beneficiary inherits the investment of $500,000. They then wait 1 month to sell it, and it appreciates, let's say, to $505,000. It still is treated as long-term favorable capital gains. So if they sell it for $505,000, the only tax they're going to have to pay now is on that $5,000 in capital growth since they inherited it. Now, perhaps you're curious what happens if you're married. It depends on your filing status. If you are joint tenants with right of survivorship, then only half of your cost basis gets stepped up. If it's community property, which I think most people are, then it's entirely stepped up if the investment was in your spouse's name. Let's now do an example with stocks, and let's assume that 20 years ago in August of 2001, you purchased $1,000 worth of Apple stock. Now, this chart doesn't account for all the stock splits that have occurred in the last 20 years. The share price was not 32 cents, but this is true. If you had purchased $1,000 worth of Apple stock in 2001, you would currently have 3,125 shares. What would that be worth? Multiply it by the share price, and the value of your Apple stock has been increased to $464,375. Now, this doesn't account for dividends that you've been paid out over 20 years. Let's assume you were not reinvesting. Just the capital appreciation, you would have $464,000. So your cost basis 20 years ago was $1,000. The value of that stock today, $464. Let's assume that you sell it one day before you die. You're going to incur a capital gains of $463,000. So assuming you're married, what would the long-term capital gains tax be on that sale? It would be $57,386. But what if you plan to never sell this stock while you're alive and you just hold it until the day of your death? You then pass this stock to your child and they inherit it. This is when the step up in basis occurs, and the new cost basis for your child for these, let's see here, how much? 3,100 shares worth of Apple stock is now $464,000. And it's treated as long-term capital gains for the first year. So if your child wants to immediately sell it, no taxes are incurred. If they want to wait a month or 6 months, if it continues to go up, then they get long-term favorable capital gains. The last thing I want to warn you guys about is the step-up in cost basis rule only applies to ordinary taxable brokerage accounts. So if you're investing in just an ordinary taxable brokerage account and you die, your beneficiary inherits the cost basis on the day of your death. However, what about retirement accounts? For a Roth 401k or a Roth IRA, if you have millions of dollars in there, it doesn't matter because this money was never going to be taxed anyways. What you need to watch out for is a traditional 401k and a traditional IRA. Let's say you've been investing heavily in one of these accounts and you've got millions of dollars in there by the time you die. You might hope that, yes, you died, this can pass to a beneficiary and the cost basis will adjust. However, that's not what the rule is. If you're investing in a traditional 401k or IRA, this money, upon your death, has to be rolled into a beneficiary or an inherited IRA. And your beneficiary will still have to be paying the marginal tax rate on this money forever. Upon receiving this inherited IRA, your beneficiary will have to start taking required minimum distributions and paying their marginal tax rate on this money, so you never get the benefit had you just been investing in an ordinary taxable brokerage account. It also doesn't matter if your beneficiary isn't 59 and a half yet. These are the rules. They will have to start taking distributions, though they can just take the minimum amounts. But there's no way when investing in a traditional 401k to pass on this money to a child and have them avoid the taxes. So there you have it, guys. This is the step up in basis. This is very controversial for tax purposes, given that somebody who bought $1,000 worth of Apple 20 years ago never paid taxes on it ever. And if they just die and then pass it to a child, once again, nobody is ever paying taxes on this investment. It's debatable whether this rule will stick around. It could potentially change in the future. Either way, while it's in place, when doing estate planning, take advantage of it. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, or you know something I don't, let me know in a comment down below. Till the next video, take care.